Good afternoon, everyone, and welcome to our Q2 webinar, in which we will discuss the latest industrial and retail sector trends in light of the current slowdown in economic activity. We will also analyse the latest developments in occupier and investment activity during this session. We're delighted to welcome Paul Weston, SVP Regional Head, UK at Prologis, and Andrew Wadsworth, Property Manager at DHL, as our guest panellists, who are going to be sharing their insights on how the sector has recently transformed. Today include Matthew Thompson, Retail Strategist at Colliers International, Lem Rosso, who's Head of our Industrial and Logistics Department, and Andrea Ferranti, who's Head of Industrial and Logistics Research. At the end of the session, there will also be a general Q&A with questions that many of you have already submitted ahead of the webinar, but please also feel free to ask additional questions throughout the webinar via the Q&A box at the bottom of the screen. I'm now going to hand you over to Andrea Ferranti, Head of Industrial and Logistics Research. Thank you.
Let's try again. Good afternoon, everyone. Hi. So it's going to be a packed event with insights, and our guest speakers will be able to tell you a little bit more of what's going on in the sector and the view for the next few months and going forward. But let's first start with a PMI activity. So PMI are survey-based data, which tend to indicate future performance in the business and manufacturing sector. So what we've seen on a monthly basis, we saw a sharp contraction during the lockdown, but month on month we see this rebounding. Any level below 50 shows a contraction in activity. Anything above 50 shows expansion. So the services activity is actually still below the 50 level, marginally. Manufacturing has increased relatively to the last month. We have the Chancellor of Exchequer speaking at the moment with new economic measure to protect jobs and boost economic activity. So we'll see the latest measure being released properly over the next couple of hours. But we will then assess whether or not the economy is going to bounce back in 2021 and 2022. So it remains to be seen how the UK economy is going to react to the current situation. With regards to online sales, so because of the lockdown, we've seen an unprecedented growth in online commerce. For the second time on record, online sales volume broke the barrier of 2 billion. In terms of online share, we actually reached 32.8%, which has been a step change, a great acceleration in uptake in terms of consumer spending on online. Of course, the industrial logistics sector has partially benefited from that, although there are some economic headwinds. But on this note, I'd like to ask Len his opinion on what has been seen. Clearly, at the moment, we are really steaming ahead with that. But what's the outlook, Len, in your view?
Thanks, Andrea. I think from our perspective, it's been fantastic what's happened from an online sales perspective in lockdown. It's gone up to 32% for the month of May, which is an amazing figure. When you look at on a yearly figure, basically circa 20% year on year for online sales. There has been a structural change with all of us, where I think we've been ordering more online. And I think this will continue this trend when we do get back to a normal environment. When that may be, we're not sure. But I do feel that even sort of elder people will continue to order their groceries online. A lot of other people have been buying stuff online, which is fantastic. I think there's always two sides to the coin, though, from online. Whilst it's great from a logistics perspective, and we all know the stat, for every increase of £1 billion spent online, you need 1 million square feet of logistics space. I'm going to hand you over to my colleague Matthew Thompson in the retail department, so he can actually give the retail's perspective from this, because as I said, there's always two sides to the coin. So Matthew, it'd be great to hear what you've got to say. Thanks, Len.
I think in short, we can expect to see an elevated level of online spend against pre-COVID levels, and recent surveys support that thinking as well. A recent study we've seen showed up to 40% of shoppers expect to buy more online food in future. Having said that, we've been keeping a close eye on the early trend data for both online and offline following the reopening of stores in mid-June. And visits to grocery, health and beauty and DIY retailer websites have actually dipped a touch in the last 2 weeks. But let's be clear, the visits to these websites still remain above the pre-lockdown average. But it's just interesting to note the synergy between the two channels as stores have reopened. And interestingly, visits to fashion websites have bucked that trend and have grown since the stores reopened, indicating both a halo effect to online and a reflection that customers still do not yet have the same levels of confidence in visiting physical clothing stores. And at the moment, broadly in the retail sector, shoppers are visiting with more defined missions. Not only are they making fewer visits, but they're visiting fewer stores per trip, and ultimately conversion rates and basket sizes are up. So I think, to summarise, social distancing measures and other safety restrictions will remain in place, as we all know, in some form or another for the rest of the year, and probably at least till the first quarter of 21. So this will hamper physical retail sales and, in my opinion, keep online elevated above 25% for some time.
Thank you very much, Matt. It'll be interesting to hear from Paul now what his view is.
Yeah, thanks, Andrea. Good afternoon, everybody. I think the genie is out of the bottle as far as online's concerned. I think what COVID has done is probably brought a 2, 3, 4, maybe even a 5-year transformation in terms of people's approach to shopping online. Probably seen that most in the grocery sector, where you've seen almost a doubling of the amount of groceries done online. Now, I can see that dropping back as we get to some sense of normal, but you certainly see in the market the inquiries from the likes of Ocado, M&S, Waitrose, that there are strong inquiries out there to grow their platform. So I think the biggest change for me will be in that online grocery sector, and for that to sort of, it will to continue. Perhaps not at the same levels as at the moment for obvious reasons, but certainly to be a stronger area for growth.
Thank you very much, Paul. That actually leads us nicely to our next slide. So take-up activity. I mean, we were all expecting a dip in activity because of course, economic headwinds and lockdown measures, etc. But the growth of online has really caught us off guard in terms of how the industrial logistics sector reacted to that. And as Paul mentioned, some extra short-term requirements were absorbed by third-party logistic provider or the existing logistic network. But the first half of 2020 actually saw nearly 18 million square feet of space being taken up. This is 20% higher than what we saw in the same period in 2019. Grocery sector, of course, online, third-party logistic demand linked to retail, fashion, etc., all bolstered activity into the sector. Len, I'm not sure if you want to add anything to that. We were expecting 2020 to be not a so great year over the past couple of months. In 2019, we were extremely buoyant pre-COVID, and what have you seen in the market and what we can expect to see the numbers be over the next few months, if you have a view on that?
Thanks, Andrea. Yes, I think the first thing to say was at the beginning of this year, prior to sort of COVID, myself and Andrea, we were sort of forecasting that 2020 was going to be an absolute record year. That said, we tempered our expectations when COVID really hit us hard. After that, we were looking very much from our perspective. We thought the take-up was going to be broadly sort of along the sort of 10-year average or just below, so circa sort of 27 million square feet take-up. That said, the take-up to date has been absolutely fantastic. I would say the logistics sector is not immune, but it's been very resilient. And because of that, I sort of feel that we might actually get to a record year, which, taking into account what's happened out there, would be absolutely an amazing sort of achievement for our sector. I think the other thing to look at, and we'll come on to that shortly, is about the take-up versus the supply. And that's quite an important dynamic. But maybe on that note, Andrea, I'll hand back to you and we could talk about that in a moment.
Thank you very much, Dan. Yes, correct. I mean, if we look at the other side of the equation, of course, here what we wanted to analyze is spec deliveries for unit 100,000 square foot plus and current supply. Of course, in between these two charts, you might envisage take-up activity. So on the left-hand side, as you can see, the development cycle has strengthened, particularly post-2018, during 2018. In 2016, there was prior Brexit referendum. We actually saw a lot of space being committed and delivered. Then in 2019, we were close to break that record. Few units actually were delivered in 2020. And the first half of 2020 saw 4.3 million square feet of space being completed. And there is also a further 5.2 million square feet, which is currently under construction and scheduled for completion by the end of this year. Some of these units, of course, I mean, it's highly probable that they might end up completing in 2021. This is just natural, can happen, some slight delay. So we envisage 2020 to be in line with 2019. But the most important thing is that while there are some more schemes being marketed for completion in 2021, there is nowhere near what we've seen over the past few years. So we definitely expect 2021 to have fewer deliveries and smaller space being delivered. But to be honest, there's been a complete change in the composition of available supply. So now there is a lot more grade A space, which is good for occupiers as they structure the supply chain and they go for better schemes. And also current supply is actually very well balanced. So we are, at the moment, we are looking at around 34 million square feet of space, depending on how you include the schemes which are scheduled for completion over the next 3 to 6 months or next month. But all in all, we actually saw a contraction in current available space, which is pretty much in line with a 5-year average. So the market seems to be extremely well balanced. Of course, there are some markets which have a little bit more space coming through, depending on the availability of development land. But on the other side, there are some markets which have a really little supply available, which is pushing up rental growth. But on this note, I'd like to, again, Len, take your view and see what you've been seeing, even by speaking with clients, how pricing and rents have been developing over the past few months.
Thanks, Andrea. Yes, I think at the moment, I think you pretty much said it, but the supply versus take-up is pretty much, I would say, spot on. And I also think that could turn very quickly. You know, we do envisage, as we said, we're definitely going to get to the 10-year average for take-up. So we've got a supply of circa 34 million square feet. It's broadly going to be, you know, a year's supply available in the market. and I think that's about perfect, but just, we're going to come on to another slide in a minute, but there are a number of large sheds which have interest in them. And, you know, potentially this supply dynamic could change, where there potentially could be an imbalance, where there is not enough grade A space available. I always think it's really interesting, though, to find an occupier's perspective on this and to see what they think when they're out looking for opportunities in the market, if there is enough for them to look at. And on that note, I would like to bring Andrew Wadsworth of DHL in to see how DHL have been experiencing looking for accommodation in the current climate.
Thanks, Len. Hello, everybody. Yeah, we're finding it challenging, I suppose, is the one we'd probably say the most. Finding the right stock in the right locations is always our biggest challenge. We have various requirements like so many others do, but finding those suitable facilities in affordable locations, it is a struggle from our perspective. You know, with flexibility with clients' requirements coming in with quick turnarounds potentially, it is sometimes very difficult to source the suitable properties that we're looking for. It has knock-on effects with term requirements and things along those lines as well because of that lack of supply. We do tend to find it can be difficult when we've got short-term contracts that we're looking to source or to find space for. So it does become a bit of a challenge for us finding those ideal opportunities in the market.
Thank you very much, Andrew. Let's now move on to the next slide here. So this is pretty much what you mentioned, Len. I mean,
yes.
there are few units with, I wouldn't say with a proper name interest, because of course we don't want to discuss these kind of things, but definitely there is occupier interest in some large units in the UK, particularly those ones.
Thanks, Andrea. Yes, I mean, as I was alluding to on the previous slide with the supply, there potentially could be an imbalance, and Andrew's already said it's not been easy to find accommodation. So if you were to sort of some of these transactions actually go ahead, if the market rumours are correct, it potentially could leave an imbalance. Maybe it might be a good time to bring Paul in to see if he's got any views on this market interest, or the space is going reasonably quickly from Prologis' experience.
This isn't the bit where I disinstruct you on any of our things, Lenny. No. I think it would be wrong for me to comment on market rumour, especially when we're in a blackout period. So I can't necessarily give you any flesh to the bones that you might like. But what I will say is that, you know, we've been pleasantly surprised by the take up in the market, and it's picked up quite a momentum, particularly over the last sort of month to 6 weeks. And you and I were around in 2009, and looking back at Andrea's chart of the grade A supply, we had about 25% of the market then. We had about 5 million square feet vacant, and it was a very quiet time on the phones. It was a really hard slog. In fact, I remember going to see Kevin says this story at DHL, that I turned up to show him sort of our wonderful portfolio of vacant space at the time, and he said, "Here's 5 million square feet. You can have whatever you want." And then he threw back at me all the grey space they had, which was about another 4 million square feet at the time. So we just laughed. So we certainly aren't in that situation this time. And there are winners and losers, and perhaps we'll touch on those later. But it really is a very different world here that we're looking at today than we were facing the recession of 2009.
Thank you very much, Paul. Yeah, I completely agree, particularly if you look at the stats. And then, of course, you have a direct experience back in 2009 dealing with your portfolio property. But just echoing what you mentioned, if we look at rental growth, you got to put those figures into perspective. So we were in a full lockdown. These are the May monthly data. rental growth across all sector, valuation driven, based on the MSCI sample. As you can see, the industrial sector on a monthly basis actually grew. I mean, it was stable, 0.1%, but it outperformed all the other UK sector, even large-scale residential PRS on a monthly basis. But if you look at the sub-segment within the industrial sector, they're all pretty much homogeneous. So we haven't really seen, we've seen rents plateauing as a whole, with some areas, particularly around London, Southeast, still experiencing supply-demand imbalances, and of course, not much stock being available there. But the reason why I brought up these statistics is that we just finished fine-tuning our models with our forecasting team, and we were debating whether or not this year would see a contraction in rents because, of course, of a strong contraction in economic activity, which is expected to materialize with the final Q2 data. And of course, Q3 will see a rebound because comparing to the previous quarter, which has shown a strong contraction, but all in all, the economy will suffer slightly this year. Having said that, because of everything that we mentioned in this webinar so far, and the imbalances that we see in many markets in the UK, we don't expect any rental contraction for the industrial sector in the UK for this year. Actually, if all the economic policies and the job markets can help that hold up nicely, potentially, 2021 will see again growth and for the industrial sector, and it definitely is going to outperform all the other UK sector. That's based on our base case assumption of a moderate recovery in 2021. But let's now look, sorry, I seem to be in trouble in flicking slides through, but let's look at the quarterly rental collection. So this data are actually collated by our property management department based on their portfolio. They've been so kind to share the analysis with us, with the entire audience here on this webinar. So what you're seeing here, you're seeing the Q2 rental collection for the top 6 subsector, and then you got Q2, the end of the quarter, 23rd of June. Then of course you got the first day, 24th of June, and then you have the Q3 plus 1 week, which was just last week or a few days ago. As you can see, industrial logistics for large unit under 1,000 square foot plus have shown to be the most resilient. And the reason being is, in our view, of course, is because of what we've seen in the market with extra requirement, growth of online commerce, and extra demand stemming from this acceleration in structural change in consumer behavior. Another reason is, of course, that those large occupiers are large corporations with a much more diverse business, whether it is geographically or online, offline, or across different sectors. So those companies have been able to oblige to their rental obligation better than other sectors, also smaller occupiers. Speaking of smaller occupiers, as you can see, we also been able to segment between industrial units between 10,000 and roughly 99,000 square foot and below 10,000 square foot. As you would expect, the smaller is the occupier, the smaller might be, definitely could be the cash reserves and how they deal with cash flows issues. And here you've seen, of course, some small and medium enterprises struggling a little bit more with the rental collection data lower than larger occupiers. But I won't comment on the other subsector because this is not the right event. But what I want to, I'd like to hear more from Andrew from DHL, because of course DHL falls within this category of a large occupiers with a global and more diverse business. Andrew, what challenges have you seen and have you experienced over the past few weeks or months?
Yeah, we've had the challenges like everybody else, generally from the businesses saying everything it's a struggle. You know, paying rent is difficult for a lot of people. But obviously when we've gone out to the market, we have come with a fairly strong covenant in here, and we're looking to sort of continue our obligations. We're meeting our obligations because that's what sort of the investments are based on. You know, we're going out to the market with DHL as a covenant and sort of looking at that, and we are honouring our agreements. We're getting a lot of pressure to sort of obviously try to make savings where it's difficult in these difficult times as well. But obviously we're taking the view that obviously we're in the market, we're paying these things there, rather than looking for any reductions or anything like that. If there are times we can look at potentially re-gearing leases or varying leases in return for some benefit to do that, that's where we've been looking to try to save money in the immediate times. So we're trying to basically trade on the covenant, and again, going forward, we're just looking for this to be sort of taken into consideration when we go forward and we come out the other end, that, you know, we are there, we're paying the rents, we're reliable in times of crisis, and looking for landlords and investors to remember that going forward and reflect that in the future, because if times go tough again, we're sort of hoping that the memory will be there, that we've been there and been reliable throughout this process.
Thank you very much, Andrew. Then this leads us nicely to what's going on. Sorry, yes. This leads us nicely to our last slide. If you could bear with me a sec. I'll start talking about the last slides in a second. So what we've seen investment volumes contracting for 2020. Hopefully stay stable now. I managed to get it on. Perfect. And so for 2020, these are the monthly data. For the quarterly data, sorry, just dealing with some issues here, but now it seems all fine. So for the quarterly data, these are actually property data investment volumes. What you see, you can see long history. Q1 2020, we've seen around 1.6 billion transacted for the quarter. But this is slightly lower than what we've seen in 2019. And Q2, sorry. There you go, I think it's all fine. Yeah, last minute IT glitches. So for Q2 2020, we saw actually a strong slowdown in investment volumes. These are several reasons. That's because of several reasons. One, of course, is the economic contraction expected towards the end of the year. But also, occupiers are assessing what's happening over there. But the main reason is actually there is very little stock available for investment. And some developers, traders are actually holding on to their stocks. There is very little stock coming forward. So we expect this to be another issues around investment activity going forward. So this year, we might actually see investment activity being below the last 5-year average, which could be something expected given where we are in the moment. But now what I'll do, because we finally managed to go through all our slides despite the IT issues, I'll hand you over to Hannah, who's gonna moderate the panel discussion, the Q&A session. Hannah, over to you, please.
Hi again. So just before we start the moderating and Q&A session, we've got 3 polling questions that we would like some audience participation on. So please can you answer the questions that are now being uploaded onto the screen with either a yes or a no, and we will reveal the results in our follow-up webinar email after the session. So I'll just leave you Paul, for a few minutes to answer those questions. So the first one is, given the growth of e-commerce, do you think that there is enough stock to accommodate extra demand for last mile logistics in the UK? Question number 2, the UK government has pledged to become carbon neutral by 2050, and this in turn will help to sustain the high street. This could increase the cost of deliveries. So in light of this, would you expect this cost to be passed on to the end consumer? And then the last question, during COVID-19, the UK logistics sector has become the backbone of our economy, and occupiers have required extra flexibility to react to unpredictable pickup times. In light of this, do you expect warehouse space lease lengths to continue to shorten? Many thanks. So now this leads us on to our moderating and Q&A session. So Matt, firstly, it was really interesting what you were talking about regarding e-commerce and retail. And what would be good to know from you is, how has the pandemic changed the role of the store in the retail sector? And can we expect to see any future changes to the way that people shop? And, you know, how do you think this is really going to impact the way a store will operate in the future?
I think there will be some quite considerable changes in the way people are shopping. I think we've already seen that. I think from drawing on our own research, it was prior to COVID-19, we saw that over 50% of online transactions take place within 5 miles of a store. And that's a pertinent stat, I think, for us at these times, as what we're seeing in the news. It's those operators that do not have an optimized store portfolio and an efficient web-based platform are those operators that are falling by the wayside. And obviously, it's challenging times in the retail sector drive innovation, and retail is one of the best at adapting. I think we can expect stores to be more efficient, and here we can't underplay the importance of AI on the sector as well. This gives retailers the capability to sharpen their inventories, drive better use of space, be more flexible on their pricing, and streamline fulfillment, all through demand modeling. We can also expect fewer, better stores, something that we've been hearing about in the retail sector for a long time. But stores of the future will be better at driving engagement and attracting new customers and retaining existing shoppers. But also, there's one final, perhaps the most important point here, given our audience today, is the fulfillment piece. Shipping costs and final mile delivery are an ever increasing burden on profitability across the retail sector, and there are countless examples of this. And it's my belief that space in the right locations will both deliver a competitive advantage for online, but it will also streamline customer service and alleviate some of these high fulfillment costs. So really, we can expect click and collect to grow significantly in the coming years. And my team at Colliers are leveraging some unique data sets to identify footfall trends and track the recovery, particularly in context of click and collect in locations across the UK.
Great, thanks so much, Matt, for that. And moving on to you, Paul, based on what you were saying, do you think that warehouse design will change over the next 5 years? And if so, what do you envisage the key drivers to be?
Thanks, Hannah. So picking up the sort of big box side of distribution, the biggest issue that was facing our customers before COVID was labour and how to attract and retain staff. I think that agenda is still going to continue. We may get a moment with COVID where suddenly the unemployment levels rise, but that desire for our customers to attract the best and to retain the best staff is really important. we've been addressing that through something we call Part Life. We've had a look at buildings in terms of providing a much bigger welfare offer, and our building at Durft is one where we've actually trialled that, and the reaction from a number of customers who viewed that building has been incredibly positive, and that whole push for well-being is going to continue. And I've got to say, it's great to see others in the sector following that as well. I know CBREGI are doing some buildings now with great well-being features. I think Gaisley have just announced they're going down that road with welfare as well. So I can see that continuing to move. I guess one of the other sides of this COVID crisis has been maybe a push to more automation, to, you know, in terms of the numbers of people in buildings, and that has a knock-on effect in terms of power that's required for buildings. And I know Len has talked about that previously, but also the height of buildings as well, in terms of making them efficient to take automation. But one of the big issues that a lot of customers will face is around CapEx, and just the sheer expense of putting in an automated system is going to be huge for some. And also, I think there's a fact that you could be waiting 2 years to get hold of a system because there is such a backlog at the moment. I think the other thing that's coming down the track is just around the approach to transport. Before we hit COVID, the push from the young around environmental issues was huge. The noise around air quality in our cities was huge. And actually our investors are also very much advancing their own ESG agendas as well. So I can only see a rise in electric vehicles and finding alternative, you know, ways from a petrol combustion or diesel engine to actually get product to people. And then the other thing, I just touch on urban perhaps, and I think the biggest change over the next 5 years, if you look in London, I am very sure we'll see a multi-level or multi-storey building in the not too distant future. Oh.
Brilliant.
Anna?
Thanks so much, Paul. Okay. So we're now going to move on to the Q&A. So as mentioned, various people actually submitted some questions in advance of this session, and we've had quite a few questions also during. So Andrew, this is one for you. What is the most important thing for DHL when acquiring space?
I think as Paul's unfortunately has alluded to, and he's stolen my thunder a little bit, a number of the things that we are obviously factoring in with our requirements will be around sort of labour availability of suitable employees and the like, and definitely power is a very big driver as well because of this, the Go Green agenda and future-proofing sites. We're having a lot of challenges in finding the facilities and ensuring that they've got sufficient power for our future needs. Because of the ever-changing markets that we've got, the location is key to where we're going to be, whether it's servicing sort of the 3PL commercial clients and what they're looking for our parcel businesses, making sure that they're in the right location for either access to the customers, the airports, however that will be. So location is a very big driver, as well as the power. But also from our point of view, it's that flexibility. As things are changing, it's being able to react to what's coming up. The sort of long leases, as we were alluding to earlier, do hamper our ability to react to what the businesses are requiring, and going forward with potential changes in the market with who knows what's coming around the corner, our ability to be able to react quickly is going to be a key driver for us.
Great. Thanks very much. And another question for you, Paul. How are occupiers meeting the demand of the boom in online retail, which has been brought about by lockdown, COVID-19, and do you think that's impacting real estate strategy?
Yeah, I think it's probably worth just touching on what we've seen since early March, and it's felt like there've been a number of waves of demand that have come out. We as soon as we locked down You know, on the back of not being able to get a toilet roll or a bag of pasta, we had this massive noise around a lot of requirements for the grocers, but obviously also a lot of health related inquiries as well. A lot of those grocery led requirements seem to be absorbed pretty quickly actually into existing space that 3PLs had, or indeed in the likes of Tesco. They went back into a couple of vacant buildings they had in their portfolio. The NHS obviously have done a few deals in terms of taking buildings for PPE and the like. Then went a little bit quiet, and then we suddenly saw another wave starting to appear of short-term requirements that were on really on the back of the social distancing. So a lot of the retailers thinking how they start to manage social distancing and still get product out. We certainly have seen that, and more NHS related inquiries. And then we've seen sort of Amazon really making a massive move into the market. I think Andrea and I talked about this earlier. There've probably been about a third of all take up in the first half of this year, which is quite something. And I think it just shows them, you know, how their business is growing in light of the current crisis. As we go to a third wave, I touched on it earlier, that there are more longer term requirements coming out, whether that be online grocery. The e-commerce guys are certainly all out there. Be interesting to see whether some of the retailers who haven't traded through the period because they didn't really have an online offer, whether they suddenly start to look at that, and whether that will bring some growth. But one thing we haven't really talked about is onshoring or nearshoring. You know, you've got a lot of supply chains that were put under incredible stress by needing to bring things in a boat from China or elsewhere in the world, and I think we're going to see a wave, maybe not quite now, but in the not too distant future, of businesses looking to have more resilience in their supply chains and the ability to store stock rather than necessarily just being reliant on just in time. I touched earlier on the fact that I think there are winners and there are some losers, or some businesses that have really had a tough time and are continuing to have a tough time at the moment. I don't think we'll get a very clear picture on how that's going to pan out till the end of the furlough period and later on this year. But I think there is a concern that I have that we could have some second-hand space coming back. But that actually might fit quite well in the slowdown in new spec development coming forward. So, there should be some space coming forward for the market. So, hand that back to you, Hannah.
Great, thanks so much. So now, Len, question for you. Are you seeing evidence that investors recognise the strength of companies within all e-commerce exposure?
Thanks, Hannah. Yes, I mean, I think over the last 5 years, it's changed dramatically. I remember going back about 4 or 5 years, and Ocado signed on a new facility down at Erith, which was a multi-story facility. And basically, at the time, that needed to be funded in the market. And from recollection, I remember that there was interest, but there wasn't the levels of interest if that investment was to come to the market now for something in, sort of within London, e-commerce, someone like Ocado. I think, that would actually, you'd be knocked down in the rush for that type of product now. So I think from an investment perspective, yes, we've seen quite a few changes. Amazon, of course, if you go back a few years, they were taking multi-story units where these were trading at sort of low fives in the market, and I think a lot of those that are to come to the market now, they'll be trading at the low fours. So I think there is a huge value on the online successful companies where the investors actually really value that as an investment commodity going forward. And I only see that compressing, because I think the other issue is that there's very few developer traders now. And consequently, because of that, Andrea touched on it earlier, we're seeing very few prime products come to the market with these types of occupiers, because obviously they're so sought after and so rare. Generally, the developer or the fund who's actually doing the development would hold on to them. So hopefully that answers that question, Hannah. Back to you.
Great, thanks, Len. Matt, back to you. Which retail sector will likely recover the quickest following the relaxation of the lockdown measures?
I think I'll start with an initial sort of overall view, which is, I suppose, the overall pie has shrunk. The total retail market is set for its first sales decline overall in a number of years. 25 billion is the latest estimate. It's knocked off in terms of total sales. We can expect a bounce back next year and then further growth in the years ahead. But if you look, sort of peel back the layers and look individually at different categories, clothing and footwear is probably the area of retail that's going to get hit the hardest. And that's largely due to their non-essential nature. The eliminated need for new clothes throughout the lockdown is quite clear, and obviously going forward, the public minimising their social interactions in the foreseeable. So I think we can see a sluggish recovery in that particular part of the market. The furniture sector is and the sort of bulky goods sector is in a similar sort of line, where housing transactions have been halted, certainly in the last couple of months. So we'll have to see how the housing market picks up to determine what happens in that sector. Looking ahead, the ones that we can see clearly growing is obviously food and grocery, and I think that's probably the biggest one, set to grow around 7% this year. That's adding an extra 6-7 billion onto the total market spend in that particular sector, and that's, you know, the grocers have benefited from consumers transferring spend from restaurant and pub owners in the short term. So I think we can expect a shift back, obviously, as these types of operators reopen. But those are the types of sector, that sort of sector we can see doing well in the longer term.
Great. Thanks, Matt. And Andrew and Len, I think this is a question for both of you. It's all about rental growth, and it'd be good to hear from you in terms of where the tipping point is in terms of affordability and where the balance is for tenants. So if either of you want to take that.
Andrea, should I sort of start off first from a sort of more agency perspective, and then you can maybe follow on with more of a forensic sort of look at it. I think it's a bit of a balancing act, because if you look at it from an occupier perspective at the moment, rents have gone up significantly over the last sort of 2 years, particularly in the southeast. And from a sort of fund development and sort of landlord perspective, you know, our view is, particularly in the southeast and London, you are going to see continued growth. Paul touched on it earlier, because basically it's just such little product available. There's huge pressure on the opportunities which do come up. So I feel you will still continue to see substantial growth there. And it's going to be really interesting. We're at £20 a square foot for sort of Park Royal at the moment, and you're almost sort of approaching up to almost £7 in the Midlands, albeit mid-6s at the moment. You know, when we were talking about those sort of rents 3 years ago, someone would have said you're sort of mad talking about that. But, you know, I think we are getting closer to that tipping point. But I do think there's always another side to the coin. You always have the retail experience, where industrial logistics rents still look quite competitive, even now compared to some retail rents. So I think, to answer the question, try and do it more succinctly than ramble on, I do think over the next 4 to 5 years, that's when we'll get to some sort of tipping point within the logistics sector. Andrea, I don't know if you have some thoughts on what I've just said, but I'll hand back to you.
Yes, I'd like to add a couple of points before perhaps asking Andrew, because of course he's on a daily basis dealing with his staff, trying to lease warehouses around the country as well. I mean, what we've seen, I mean, the lowest ever supply data that we have on record, I think happened a few years ago, pre-Brexit referendum. We had about 28 million square feet for large distribution warehouses available around the country, which was the lowest ever. Post 2009, 2008 financial crisis, like Paul actually mentioned earlier on during the webinar, there was a lot of space available. Our figures actually shows that we were at around 100 million square feet available in the market. So if you consider strong online growth, moderate economic growth, then of course this is disappearing at the moment because of COVID-19 and structural change in consumer behavior, rents to go up. That's simple as that. What is the balance between occupiers and landlords? The market dictates pricing at the moment. So depending on location, occupiers are going to have to tweak their strategies or trying to become more efficient. As long as it's going to be an occupier being able to pay that rent for that particular unit that perhaps you might be looking for, the only reason to be able to afford that rent is to become more efficient, providing that there is a consumer base making you profitable. But of course, this is from an analyst point of view. Andrew will have more insights of what he's seeing in the market and how they're dealing with some high rents across the UK. Andrew, do you want to add any comment to that?
I'd agree with the sentiments that have been there. From our point of view, obviously it's a constant driver when we're talking to customers, particularly on the 3PL side of the business. We're going in saying, oh, rents are going up, and they're saying, oh, driving costs down. So we're sort of going against the trend when we're sort of going in for our pitches with the customers. So it's a very difficult circle to square sometimes on that rental front. We can justify it as all we want and explain it, but if the customer's not prepared to pay it, then it becomes very difficult for us to take things forward. They are a big challenge. They do form a very large element of what we're doing going forward. Where we're seeing sort of those really high levels, like in the southeast, it does have a significant bearing on what you're going to actually put in those locations. You're not going to be putting slow-moving products in those locations. So it's changing sort of that thought model that we have to some degree about potentially having smaller, more flexible buildings, which you can then be more adaptive and more reactive to, where the rents are significantly higher. Where you might want to take 200,000 square feet, for instance, you're not going to potentially be looking at something like that. In the southeast, you might want something a lot smaller, a lot more flexible, cross-dock to get things in and out quicker, so it's not sitting on the floor. And sort of going that urban logistics way, smaller centres which you can react to, which we will look at there. But as I say, rent is definitely one of the big pushbacks we have all the time. It's always a challenge for us.
Great, thanks very much, everyone. We've just got one last question that's come through during the session, and quite a few people have actually been asking about the sustainability and carbon neutral green agenda. So what do you think the effect of the green agenda is coming to the forefront, and especially in urban areas and for final mile facilities? So what do you think about this whole agenda in general?
Do you want me to have a go at that? I can start with that.
Go first.
I sat around a table with some of our investors back in November, and we talked about the Cool Earth programme that we've been involved with for, 12 years now, which is around protecting the deforestation of rainforests through our development. It's been incredibly successful. We've basically protected an area about bigger than Zone 1 of the London Underground to date. But our investors were really keen to hear that, and as the Greta Thunberg, all of those themes that have come on, it's got much higher and higher and higher on investors' agendas. 5 years ago, it wouldn't have been the number one thing they wanted to talk about. Now it is. And businesses, in the sector we're in, we use a lot of resources. We use a lot of natural resources to put our buildings together. the operational carbon of our buildings is huge, which is why I talked about, you know, the electric vehicles, and, you know, use of rail is a great opportunity to take HGVs off the road. So it isn't going to change. It's moving at a pace, and I think in urban areas it's going to move even quicker, because we were already starting to hear about, I'm trying to think, Bristol, there were London, a lot around high levels of NO2, and how people you know, are very, very concerned about that. So our industry has to respond to that, and the logistics businesses also have to respond to that.
Thanks very much. Okay, I think we've actually almost run out of time now, and there are a few more questions left. So what we're going to do is, we'll certainly be sending an email round after this session with all of the answers to all of the questions, along with a YouTube recording of the whole session if you want to watch it back and go through any of the points that were discussed today. In addition, we'll be sharing the answers to the poll questions that we asked just ahead of this session. But we also just want to thank you so much, everyone, for joining. And if you've got any other questions or any other queries or feedback, we'd be delighted to hear from you. So many thanks for attending, and that's the end of our session.